I want to shine a light now on how the market is reacting to this report because we know the stock market suffered its biggest one-day drop in 3 months yesterday. Those high-flying tech stocks is what brought us lower. And right now, as we take a look at stock futures with less than a half hour to go before the opening bell, we have Dow futures now rallying more than 160 points, S&P futures also slightly in the green, and NASDAQ futures well off their lows of the session. They were down more than 150 points earlier, now trying to claw their way back down just about 85 points. Let's bring in Matthew Luzzetti. He is Chief U.S. Economist at Deutsche Bank. Matt, good to have you with us. Before we get to the markets, just your initial response to this jobs report we got today.
Yeah, thanks for having me. I think it was an incredibly fascinating report. You had jobs gains, which were very much in line with expectations, adding about 1.4 million jobs. But you had this much sharper decline in the unemployment rate to 8.4%, the much sharper decline in the U6 rate, this broader measure of labor market slack, which all was, very supportive, I think. Overall, I think another solid report. Obviously, we are seeing a slowdown in jobs gains that is happening. But I think the key takeaways for looking forward are, what does this mean for fiscal stimulus potential? And what does it mean for monetary policy, additional accommodation when the Fed meets in 2 weeks? I think it takes the urgency away from both of those things.
Matt, let me frame it this way. Let's say we do get some form of COVID vaccine to arrive into the market before year end. What does the job market look like in that type of scenario to kick off 2021?
I think that there's going to be very big differences between the market reaction and the economic reaction to getting a vaccine announcement. One, the market, I think, will react to it immediately. It tells us that on a 6-month, 12-month forward-looking basis, the economy can likely recover more quickly. On the other hand, from an economic perspective, what really matters is how broad-based the distribution is. How widely do we have people actually taking vaccines? That is going to be the key to assessing out the economic implications. And there's certainly going to be some lag between knowing that a vaccine is available and getting it broadly distributed and effective to the entire U.S. population.
Matt, I want to get back to what you said a moment ago about the Federal Reserve. Do you think that today's report gives them enough reason to sort of take their foot off the gas when it comes to pumping stimulus into the economy?
No, absolutely not. It's no reason to take their foot off the gas. What we've heard from them over the past several weeks, especially as they've changed their framework, where they want to get inflation higher and above target. They don't want to react to by tightening to unemployment that is falling lower. We still have an unemployment rate of 8.4%. I don't think the Fed reacts until we get below 4%. So in no way does this mean that they're taking their foot off the gas. It does, however, I think, reduce some urgency of putting their foot further on the gas. So providing additional accommodation at this point. There's talks about enhanced forward guidance, talks about changing their asset purchases program. And this data on the margin, I think, reduces some of the urgency on those two things.
Matt, you mentioned this might delay any form of stimulus. Do you think it just pulls any more stimulus from the federal government completely off the table? Look, 1.4 million jobs created, the unemployment rate back down below 10%. Do you even get a new plan?
The way that these discussions have evolved, I think that is absolutely a risk. And I would view that as being, something that is really detrimental to the economy at this point. Let's put everything in context. We still have an 8.4% unemployment rate. We've only regained 50% of the jobs lost. So we're still about 11.5 million jobs below the previous peak. We've had a few better than expected jobs reports. The unemployment rate has fallen faster than expected. But there's still a long ways to go. And so removing stimulus at this point, still remains, I think, a significant risk to the outlook.
Matt, how long do you think it might be before we see hiring back to pre-pandemic levels?
I think one of the interesting parts of this report, in which overall was a broadly supportive report, is you did see permanent layoffs tick up. And those people that are on temporary layoffs, they're looking more and more like they're permanent. And the reason that I say that is 2/3 of people on temporary layoffs have actually been unemployed for more than 15 weeks. That is by far a record high. And so you're seeing their unemployment durations extend. I think you're going to see, industries, whether it's restaurants, airlines, leisure and hospitality, retail, there's permanent scarring here. It's going to take a very long time to get back to those levels. We don't see output getting back to pre-virus levels until likely the early 2022. So, we have seen some V-shaped recovery in some elements of the economy, but recovering the full pre-virus potential of the economy is going to take some time.
Matt, talk to us about the dichotomy here in this report. You have office workers that look to be still employed. Then you have more workers on the low end of the wage scale. They're coming back, but their jobs are far less certain. It's very much a mixed economy, no?
It is absolutely a mixed economy. We've seen, the dynamics of these employment reports have been mostly initial loss of jobs in those high contact areas that had to shut down as COVID began to spread. And now we've recovered a good amount of those jobs, but we're still well below those levels. I think the concern going forward is, do we see a spread in these layoffs to other areas? Does it move up the wage scale in particular? And there is some evidence that is going to happen as we go through September and October. So you don't want to extrapolate what has been better than expected jobs reports in the next few months. The Fed, I think, will remain cautious. They'll continue to keep their foot on the pedal. But we are concerned at this point that these better than expected numbers mean that fiscal and monetary authorities don't think that they have to do more in addition to where they are right now.
Matt, which areas of the economy do you think will lead the recovery? I mean, now that we're seeing a lot of these layoffs turn into permanent job losses, how is that going to affect the housing market, right? Which actually had been holding up quite nicely. And many might have thought that would have been the sector that would drive us out of this.
Yeah, you've seen a very bifurcated recovery from the crisis, and one that looks very unlike what we've seen in the past. So you see good spending by consumers is about 5 or 6% above pre-virus levels, above. Things like equipment spending, durable goods orders, and shipments are basically back to normal. This does not look like a CapEx recession that we've seen in the past, but services spending is actually 10% below pre-virus levels. And that's very much outside of what we've seen historically. So it is a very unusual recession and recovery that we're experiencing. And I think you'll continue to see that. On the housing front, I think it will come down to, what does fiscal policy do? We've seen these eviction moratoriums tried to be extended by the CDC, but they're not providing any additional funding to landlords. So there's some issues there. If we do see a full lapse in unemployment benefits and no more fiscal stimulus, I think you do become concerned about rent payments being made, people being able to pay their mortgages over the next few months.